All right, market's a little changed today, but we are sitting at yet another record high on the S&P, and the bullishness just doesn't stop. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today, and Bloomberg Open Interest starts right now.
Coming up, investors digesting a heap of economic data before Thanksgiving while Trump's tariff agenda gains momentum. Dell and HP plunging in the pre-market. Both companies reported results that suggest a recovery in the PC market is stalling. And a Wall Street heavyweight joins the crowded race for New York City Mayor. Whitney Tilson will join us on the program in the next hour. Let's take a look at where markets are trading right now. In terms of futures, you're not seeing a heck of a lot of movement. In fact, a drop of 0.04%. So unchanged there. NASDAQ futures down a little bit more at 0.2%, and the U.S. 10-year yield off about 5 basis points at 4.26. By the way, that 10-year yield is 35 basis points higher than stocks are yielding right now, so the risk-free rate gives you a better return.
That's true.
And yet,
it is coming down, though.
Investors are bullish.
That's true. Let's take a look under the surface, though, because not a lot of bullishness to be found in these stocks. I'm highlighting Dell and HP. As Matt said, they both reported earnings that show that the recovery in the PC landscape is stalling out. You can see shares down quite mightily on both of these names. Then you take a look at CrowdStrike, and it's more bad news here. If you take a look, they also reported earnings, shares down about 1.7%, Matt.
All right, in terms of the bullishness, I mean, it just seems not to stop. I saw a chart this morning from Dan Curtis. I think, here it is, 1977. Look at that. So this is the Consumer Conference Board, or the Conference Board's consumer survey, 3,000 random households. Who thinks stocks will be higher? More people than ever before in this survey. So after a 26% run year to date on the S&P, after a 68% run since the October low in 2022, it looks like investors think we're going to keep on trucking.
It's interesting to marry that with this Warren Buffett indicator that was mentioned in this macro view column on the Bloomberg terminal. Buffett, remember back in 2001, he said that if the percentage relationship between market cap and GDP falls to 70 or 80% area, then you want to buy stocks. But if that ratio approaches 200%, as it did in the late 90s, you're playing with fire. Matt, where are we right now?
We're about 225% of U.S. GDP on U.S. stocks. So it's pretty incredible. I mean, obviously, it seems like the U.S. is the only game in town. And if you look at the percentage of global market cap, we're half of the entire world, even though we're, 24% of the economy in GDP terms?
So I was thinking about that because you could say, okay, we're only 0.25% of worldwide GDP, 50% of worldwide market cap.
I believe we have pie charts to represent this.
And there they are, just beautiful. Everything a well-oiled machine. But should that ratio be closer? Because you think about the stock market is not the economy. That's one point. And also the stock market is a forward-looking animal, pricing in future growth expectations. So maybe it makes sense that you do have that dispersion between the market cap as a percent of global and GDP as a percent of global.
And we continue to get higher and higher expectations for the stock market. Bank America, Savita Subramanian came out with a target at 6,666. What did she say? Disco Inferno?
Cyclical inferno,
Cyclical
baby.
Inferno. Yeah, I remember just 666, just plain 666 on March 9th of 2009. So we're up, well, in her estimation, at the end of 2025, 10 times that.
That is pretty incredible that 2009 wasn't that long ago, and still.
I feel like it was only yesterday. Let's bring in BMO Family Office CIO Carol Schleif to talk with us about this bullishness. Carol, what do you think we're going to see, in this year-end rally, the January effect, Trump 2.0? Do we just continue to go higher and higher here?
Well, our expectation is for continued progress in the markets, although we would expect more volatility than we've seen recently, especially surrounding tariffs, because we don't think he's kidding on that piece of it. We would expect some volatility. But the other thing, there's two points to make that are really unique this time around, and that's that we've basically inverted the way a bull market normally runs, because normally it starts broad and gets narrow, and this one started very narrow with the Magnificent Seven and now is broadening out, and you've got a lot of participation in mid cap and small cap, so there's a lot of opportunity to run there. And we do think that you'll see that broadening continue, and especially if the focus is on US and US exceptionalism, that the points you made before about GDP growing, we're growing faster than most of the rest of the world. Or more importantly, our productivity is growing faster than the rest of the world. And we haven't even seen this start to run. So from that perspective, if you go back to the 1995 to 2000, we had 20% plus returns on the S&P every year for 5 years there. That's not necessarily the house call, but Matt, you're commenting about some of the hallmarks you remember. I remember when the NASDAQ went to less than 1,000, and I also remember when the Dow was at 1,000. So there's some long-term hallmarks.
We've been around,
right?
Carol. Listen, in terms of, we were talking about the Warren Buffett warning, and, I guess Benjamin Graham's book has been thrown away in trading floors around the world this year. But do you have even any interest in the places where, there's blood on the streets in terms of stock valuations? I mean, in Germany, the market cap of all stocks is only half of GDP, but nobody wants to buy German stocks, right? It's still, the U.S. is still the only game in town.
Well, I think you have to be careful, especially with the EU, because you are teeing up, incoming President Trump is teeing up a trade war with the EU over a lot of things. He's irritated about the auto imports that come from there, and Germany is a classic case there. So at this point, when we're 30, 60, 90 days away from having more clarity about what's going to happen there, I think we'd pull back there. But there are parts of the globe that are interesting, but there are also parts of the U.S. that have been left behind when you take out the performance early on of those mega cap stocks. And the other factor that's weighing on the U.S. markets, or that's supporting the U.S. markets, is the net reduction in the number of shares or the number of public companies out there to buy. Because since the late 90s, we're down something like close to 40% in terms of that. So it's classic Econ 101 with supply and demand.
I find that fascinating that you're seeing the shrinking of the public markets. You have these companies staying private for longer. They can get the funding that they need there. It's interesting to hear you say that that's supportive, because I've heard a lot of people make worried noises about that. But I guess it's true, Carol. If you think about supply and demand, that could be a tailwind.
It could be a tailwind, or it has been a tailwind. But the other factor is I do suspect that you'll see there's a lot of investment banks out there that are teeing up deals, M&A deals, IPO deals. And I suspect the allure of there is something special about being a public company, regulation notwithstanding, but hopefully in a new Trump administration, we have lesser regulation on some of those companies, making it not quite so onerous to be a public company. And that would lure a lot of them out of hiding, if you will. It's pretty amazing the vast number of unicorns we have, as well as there's tens of thousands of companies on venture capital funds that have been there for 3, 4, 5 years. And so they're very seasoned companies, and we could have a very nice IPO market that would help get us back to a better balance of public versus private.
We ask this question all the time, but what would be the catalyst? Or do you think that maybe something structural has changed in how companies operate, how they fund themselves, and whether or not they do need to go public? Is this cyclical, or do you think that there's something different going on?
I think there is a secular trend. When you go back and look at the percentage of capital that's invested in private companies, there is a substantial array of investors, all the way from angel investing to early seed stage. And people haven't liked seed stage as much, but you're starting to see some investment there. If we see the opportunities for these smaller companies, particularly in AI and technology, to find their footing, there's a lot of ways that they're finding funding outside of the banking system, outside of going public. There's a lot of alternative sources, both venture capital, private capital, pension funds, lots of other ways that they're finding capital.
All right, can't imagine that is good news for the stock exchanges. Carol, have to leave it there. BMO Family Office CIO, Carol Schleif. Meanwhile, let's get a check on futures right now. A pretty quiet end. This is the last full trading day of November. Of course, we're closed tomorrow for Thanksgiving, and then we have a holiday shortened session on Friday. You take a look at where we stand right now. It's pretty quiet, down about 0.1% on the S&P 500, 0.3% when it comes to the NASDAQ 100. The Russell 2000, it was a rough day yesterday, but we're back, baby. The Russell 2000 up about 0.7%. Let's look under the hood, though, and see if we can find some action there. Here's Abigail Doolittle.
We do indeed have some outsized movers beneath the surface. Katie, starting off with Workday, you can see shares are plunging down 12.4%. This after their fourth quarter subscription revenue forecast misses the mark. The Wall Street estimates on this, Piper has cut shares to neutral, and JP Morgan's Mark Murphy is saying that investors are struggling with subscription growth slowing, and as a result, this really is why the stock is down. Turning to a stock that is moving to the upside, however, Solar Edge Technologies. They have a plan to basically close their energy storage division. This will help them save about $7.5 million per quarter. Plus, they are cutting 500 employees, 500 jobs. So the stock up 2%. You would think there would maybe be a bit of a bigger response on this sort of a restructuring plan, but nonetheless, investors are encouraged. And then turning to another laggard on the day, we have the shares of Autodesk, the software company, down pretty sharply, down about 8%. They beat and boosted. However, operating margins a little bit disappointing to some analysts. Plus, Matt, the stock up about 31% year to date into this report. So some investors wanted just a little bit more there.
Taking some profits. Abigail Doolittle, thanks very much for that. Abby Doolittle talking about some of the stocks moving on this Thanksgiving Eve. Coming up, a leaked memo from BYD signals the EV price war is going to intensify in the world's largest auto market. This is Bloomberg. Let's get now to high interest to look at what's making headlines around the world. A ceasefire between Israel and Hezbollah started early this morning. The 60-day truce puts a pause on the 14-month conflict that's killed thousands and forced more than 1 million people to flee their homes. So far, there have been no reports of early violations. A group of states led by Texas are suing BlackRock, Vanguard, and State Street for allegedly breaking antitrust law. Attorney General in Texas Ken Paxton is accusing the firms of combining their market clout and membership in climate groups to boost electricity prices. Texans and residents in other states faced shortages and had to pay higher power bills, according to what is now the highest profile lawsuit yet in the ESG backlash. And coffee is getting really expensive. Futures for Arabica beans are hitting highs not seen in 4 decades. A severe drought earlier this year in Brazil is fueling worries about the country's output. This comes on top of concerns over bean supplies from Vietnam. Those countries are the 2 biggest coffee bean growers. So actually, there's a circular story here, Katie, that these firms may have boosted electricity prices, but perhaps they're holding coffee prices from even higher inflation.
Yeah, we're going to have to explore those linkages. Very interesting story, though. It just feels like the cost of everything is going up. But the cost of EVs, at least in China, may be going down because a screenshot of an email that was supposedly from Chinese EV giant BYD is asking suppliers to accept price cuts next year in what could signal more competition in the electric vehicle market. This comes, of course, as President-elect Donald Trump's tariffs proposal weighs on U.S.-based automakers. Let's unpack all of this with Bloomberg's David Welch, who joins us now. And we'll start with BYD and these potential price cuts. What level are we talking about here? And what does this mean for both the Chinese EV market and the global?
Well, look, even BYD, its advantages in supply chain and battery technology, they're not immune to these price wars. In fact, they've probably been driving it at certain points. All the companies there are going for market share. And there's sort of a Darwinian play going on in China where the government does absorb losses or helps a lot of these companies who keep cutting their prices. keeps them afloat. But this doesn't go on forever, and the Chinese government knows that over time it's going to winnow down to a few players. Even with that, even with all this government subsidy and support that these companies get, BYD's got to maintain their profit margins. They're one of the few Chinese EV makers that's actually making money. So they're leaning on their suppliers to do it, to get a little bit more firepower to keep dropping prices. We saw Tesla drop prices just about a week ago. They offered a special deal in China for the Model Y. It's a temporary deal, but that's just part of the game over there. Everybody is cutting prices and in many cases losing money to get market share. And that's why the Western auto companies have been leaving, because they don't want to play that game.
David, there's a great function on the Bloomberg that we used a lot during the first Trump administration, ECTR Go, maps global trade. And when the Trump tariffs were announced on, Truth Social the other day, I noted that the three countries that he called out, Mexico, Canada, and China, are our biggest trading partners. And that's in total trade. But of course, in your industry, even bigger, right? Not China so much yet, but Canada and Mexico are where a lot of the biggest factories are for General Motors, for Ford, for Stellantis. How is this next administration, this new Trump administration, going to affect the companies that you cover most?
Look, you're talking about 2.3 million cars coming into the U.S. from Mexico last year, and that's a pretty good annualized number, plus a lot of parts that go back and forth across the border, and that doesn't count Canada. So look, there's a ton of trade here. If Trump came good on these threats to levy bigger tariffs, he'd basically be tearing up USMCA, which was his version of NAFTA anyways. You are talking about more inflation in car prices, period. The car companies will try to pass on any increases to consumers, and if they don't, their margins erode. So it's not good for them if all of this comes to pass. And car companies, they can't just find a new source of parts in the U.S. overnight. It takes a couple of years to build plants and reroute supply chains. So look, it would have a massive ripple effect just on the 2.3 million vehicles coming out of Mexico alone. And then you're talking about all the parts flow and so forth. And yeah, it's a huge deal if he's going to really go that big. However, he's made threats like that in the past and not come through on them. So we'll see.
I wonder, David, how this then affects the auto workers. And I know you cover the business of cars, not the politics of Michigan, but a lot of those factory floor workers voted for Donald Trump, pushed him over the edge in that swing state. And if these tariffs drive up the prices of those vehicles, aren't they going to have a harder time making money, keeping jobs?
Now, look, sales go down, workers' jobs are more at risk. And, that is a big threat to those workers. For a long time, though, they've just worried about watching their jobs go overseas. And Trump became their hero, promising to do that. And we do have huge tariffs that keep a lot of cars coming in from China. And, there were some things in USMCA, like mandating 40% of the parts content of a vehicle in order to get the cheaper tariff coming into the U.S. from Mexico. What that basically said was the parts had to come from Canada or the United States. That did probably stop the flow of some jobs from Canada and the U.S. Into Mexico. So there are some things that Trump has delivered for them. I think there are other reasons that union workers have voted for Trump. A lot of them are socially conservative, so they're more in tune with his platform. But he has delivered in some ways on this. But look, there are a lot of unintended consequences for auto workers if prices go sky high because of tariffs. Absolutely.
All right, David Welch, really appreciate that context. Have a great Thanksgiving. And it's interesting, in the broader car world,
yes,
we have an interesting IPO coming. This is called Pony AI. It's an autonomous driving startup. It's IPOing in the U.S. This is a Chinese company. It's interesting on two levels. First of all, the actual business that this company is in, and also that it chose a U.S. IPO.
Yeah, well, 3 levels.
Yeah.
Also that it's an IPO at all in this market, right?
That's true.
Yeah, fascinating to watch these ADRs. They'll kick off trading today. I believe they'll start at $13 a piece. So Pony AI, a Guangzhou-based company,
great name,
raising $260 million in the U.S. markets for a technology that, I guess, could boost EV sales because the idea is that adding the autonomous piece is going to make EVs more palatable to consumers.
Yeah, and like you said, it'll be fascinating to see the reception to that one. So we'll keep an eye on that. And coming up next hour, we're going to talk more politics and policy with New York City mayoral candidate Whitney Tilson. This is Bloomberg. All right, welcome back to Bloomberg Open Interest. We're taking a look at futures right now, just minutes until the bell rings. You can see a pretty quiet end to the month right now. Of course, this is the last full trading day of November. It looks like we're set to open a little bit lower, both on the S&P 500, on the NASDAQ 100. Your Russell 2000, of course, in the lead right now, up about 0.6%, but that's after a pretty rocky day yesterday. And I was taking a look at the monthly stats, Matt. It looks like the S&P 500 on track to rise a little bit more than about 5%. That would be the second best month of the year, and it's been a really volatile month, to say the least.
Yeah, for the month alone, right?
Yeah.
I mean, we're looking at more than 26%.
That's true.
So far this year, after a more than 20% gain last year.
It could make you greedy.
Yes.
Yeah.
Is greed good?
Perhaps.
You know, one of the things Ben Brom mentioned is that while Warren Buffett issued that warning in 2001, this year we've seen him liquidate hundreds of billions of dollars in stock. In fact, at the end of last year, he had $167 billion in cash. Now he has $325 billion in cash.
He said, you think I have a lot of cash now? Just wait. I'm going to sell all these stocks. In any case, coming up, it's the opening bell. We'll talk you through some of the biggest movers and where we're going next. This is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Take a look first off at futures. Not a lot of movement. We're down a little, but after a 50-second record high for the S&P 500 yesterday at 6,020, the NASDAQ futures are down about 0.3%. Russell 2000 futures are higher as we're hoping for dispersion in this continued rally. You hear the opening bell. On the New York Stock Exchange, Santa Claus, it looks like some elves, and Macy's employees, minus the one who charged or hid $154 million in charges. I guess she or he is not there. Down at the NASDAQ, it's Pony AI. This is very exciting, as Katie mentioned. It's a Chinese autonomous driving company doing a U.S. IPO, raising $260 million. The shares going out at $13 a piece. We'll track them at the open to see if they left any money on the table or if they got it all. Let's go over to Katie Greifeld right now. She's going to check on your major averages. Katie?
I'm going to try to sell this because it's pretty quiet at the moment. The S&P 500 down about 0.2%, but you can see losses accelerating from the pre-market levels when you take a look at big tech. The NASDAQ 100 currently lower by about 0.4%. We'll see how we settle up. Of course, for the S&P 500, on track for the second best month of performance this year. And then train your eyes on the small caps. The Russell 2000 higher by about 0.7% right now. That's about how much we fell yesterday. This index is getting closer and closer to its all-time high, though. We'll see if it can actually get there. But let's get some bad news. You take a look under the hood. It's still earnings season, and Dell earnings in particular show that the recovery in the PC market is stalling. That's after the pandemic created huge demand for computers. The company's CFO says the PC refresh cycle is expected in 2025. And it's a similar story for HP's personal computers as well. You have guidance signaling little improvement in the seasonally strong December quarter. Shares currently off by about 7.3%, Matt.
Yeah, just wait, because when AI really gets going, we're all going to need new computers. CrowdStrike surpassed $4 billion in annual recurring revenue for the first time, if that means anything at all to you. But its forecast was weaker than expected. So for those to whom that does mean something, it doesn't mean anything good. You can see the shares down 3.5%. Let's take a closer look at what's moving. For that, we go to Bloomberg's Abigail Doodle. Abby?
That outlook indeed is weighing on the shares of CrowdStrike. Right now, down about 3.4%. But as you mentioned, they put up a pretty good quarter. They put up adjusted earnings of 93 cents per share. That was 14% better than the street was looking for on a little more than the $4 billion in, the $1 billion in revenue, which was 3% better than the street. As for that adjusted earnings forecast that missed the mark for the fourth quarter, they're talking about a range of 84 to 86 cents. The street's at 87 cents. So it's very small, but nonetheless, this is what is pressuring shares. It could also be a case of too far, too fast. This, of course, is the second quarter that they have reported since that disaster with Microsoft that threw all kinds of airlines off the mark. And if we take a look at the shares of CrowdStrike relative to the cybersecurity index, which is in white, and then the S&P 500 in blue, you can see the massive fall on that debacle and then the big gain higher. Right now, we're coming off of those highs a little bit, Katie. So again, I think some of today's 3% fall for the shares of CrowdStrike has something to do with too far, too fast.
All right, Abigail Doodle, thank you for that. Let's also mention Urban Outfitters. Of course, we've been following the retailers very closely this week, a whole raft of retail earnings. Urban Outfitters bucking the trend here, climbing by 17% at one point. That was the most since May 2023. Of course, they reported stronger than expected quarterly sales growth yesterday. Anthropologie was a particular bright spot. I believe they also got an upgrade from Citi. You add it all together, shares currently up about 12%. We'll continue to follow that one. But let's
I went into an Urban Outfitters the other day.
Did you?
Yeah.
You're not really the demographic.
No.
What'd you find?
They had a lot of stuff, I will say that. The store is packed with clothing. I went to the Times Square
that sounds awful.
location. Yeah, it was, well, it was noon. It was a pretty empty day, but there was just a ton of stuff on sale. The stock's done pretty well this year. It's up 26%.
It has.
With the market, in line with the market.
Yeah, with the market, but better than a lot of its peers there. They have a lot of knickknacks, which I always appreciated about Urban Outfitters. But in any case, let's broaden out this conversation because we're joined now by Moneta Chief Global Market Strategist Aoifinn Devitt joining us now. And let's talk about the earnings that we've gotten. Obviously, some weakness when it comes to maybe the PC market. Surprising strength and surprising misses, too, when it comes to the retail side. And we've been talking about this all week, that it's really hard to talk about the consumer as a monolith right now. But you think about what we learned this week, where does it leave you on the state of the consumer and thus the U.S. economy?
I'm going to go back to the concept of a zero-sum game, because when we had tariff announcements at the beginning of the week, we thought markets would react very dramatically to that. And then there was some reference to something that the incoming Treasury Secretary Scott Bessent had said about tariffs not creating inflation, because even though it would create higher prices, consumers would simply spend less money elsewhere. So there wouldn't be anything increased in the economy. And that's what we can see in terms of this fallout in terms of earnings. We may have more spending on AI, on software, but less spending on the hardware side. And similarly, on the retail side, we do see, say, like Urban Outfitters doing very well, but an entity like Target doing badly. And really, consumers having that flex between online and bricks and mortar shopping, and that concept of a zero-sum game. So clearly there will be winners and losers, and that's a little bit what we're focusing on now, is where are the winners really going to be? And the lack of spending on hardware, that's a sign that really there is no bottomless pit when it comes to consumer or enterprise spending.
There's a lot to dig into there. Let's focus on the tariff piece, since obviously that was one of the biggest headlines that we got this week. Maybe some detail on what's going to happen to Chinese goods, to goods coming from Mexico and Canada. We heard a lot yesterday that, okay, maybe don't freak out because maybe this is a negotiating tactic. It won't actually turn into policy. But how are you preparing for the possibility that we do get levels such as an additional 10%, such as 25%? What does that mean from where you're sitting as a market strategist?
Well, we always factored this in as the Trump trade. We saw that tariffs would be broadly inflationary, despite Scott Bessent's caveat about net zero-sum games. We thought that it would also depress economic activity and would be very bad outside the US, so very bad for trading partners. Mexico and Canada were mentioned here, but we know it's not good for any trading partner, particularly in Europe. So we're already seeing that as a relative strength game, that it would play into the US, but could lead to more inflation. I don't think we expected the kind of shock and awe announcement that we saw at the beginning of the week. But equally, it's a little extraordinary how it's been tied to and conflated with a number of factors. What we have seen is that this will be inflationary. We've already seen hoarding activity going on by businesses. So that's going to create a bit more uncertainty, a bit more choppiness in the numbers we see. And generally, hoarding of inventory will lead to different appearance of margins. and it's going to make those numbers look a little different in the fourth quarter. And it also plays into the small caps. Small caps are less dependent on imports. They're going to be, I think, the beneficiary of more America First spending, and equally services that are not susceptible to tariffs, like financial services. They should be virtually untouched by all of this, unless, of course, economic activity starts to contract. So lots of different ways of playing this trade. But I will say we were taken aback by the dramatic nature of the announcement. And I think a lot of market forces were too. But yet markets, again, very resilient, did not react.
Does America always win here, Aoifinn? I mean, I'm looking at stocks, and the S&P obviously has clobbered the rest of the world. We're up 26%. England, the FTSE's up less than 7%. The Euro stocks is up, I think, less than 6%. Is there ever a time when you say, okay, Europe has done so poorly and the U.S. has done so well, it's time to move some eggs from the U.S. basket to the European basket?
That is the old rebalancing and diversification playbook that all strategists like to point to because it's always worked before. But we have to look at fundamentals. And I know the words "it's different this time" can often send shockwaves and shivers through commentators. But I will say that it is slightly different this time. Where is the fundamental driver for growth, innovation, and progress in Europe right now? There are so many structural factors at play that even monetary easing with force, which the ECB could well do, cannot essentially address the demographic changes, the dependence on Russia, the lack of innovation, the over-regulation. These structural barriers are just very difficult to get around. And we've seen that investors are voting with their feet. And similarly, the dollar is showing, because whenever an investor investing in non-US stock markets also has to bear the currency impact. So I will say that, does America always win? Well, it's certainly been winning for the last 15 years in terms of its relative performance. And I will say that at the current juncture, where the political forces are lined up, and the corporate forces, it is difficult to bet against the US. Every non-US investor should have exposure here. US investors, whether they should have exposure elsewhere, I think that's the bit we're starting to question.
Ben Rahm from our Markets Live team this morning mentioning that stocks are only yielding less than 4% right now, S&P 500 earnings yield. And I look at the 10-year at 4.25. Do bonds make sense, or is it an all-stock story as well?
Depends on why you use stocks. Certainly the dividend yielding stocks would tend to be more defensive, more value oriented. That's not been the name of the game. It's been the growth stocks. It's been the capital appreciation you've seen in those stocks, the multiple expansion. So clearly there will be some fallout in the dividend yielding stocks. But I will say that for the most part, 4% is not particularly exciting if you're experiencing FOMO and looking over there at serious double-digit returns of equities. So bonds certainly are a perfectly respectable place to sit for defensive positioning and for cash holdings at the moment. It's no longer a massive drag, but would you stay there for very long with inflation not necessarily in the rearview mirror? I don't think so. I don't think there's enough margin or spread over inflation for that to be a very meaningful compounded return over time. So I think we're going to see, yes, a bit of suffering on the defensive stock side, but overall not really a big rotation into bonds.
All right, Aoifinn, got to leave it there. Really appreciate you taking the time. That is Aoifinn Devitt, Moneta Chief Global Market Strategist. And coming up, investors are waiting for the personal PC market to boot up. We'll take a closer look at HP and Dell next. This is Bloomberg. All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Urban Outfitters, like we were mentioning, getting raised to a buy over at Citi. The retailer reported stronger than expected sales growth in the third quarter, led by its Anthropologie brand. Shares currently up almost 14%. Next up, UBS is upgrading Dick's Sporting Goods to a buy. The firm saying that risks are firmly skewed to the upside. Also sees sustainable earnings growth ahead. That rally gaining momentum right now, currently up about 4%. And finally, we have Gordon Haskett cutting Kohl's to a sell. The firm highlights concerns that the tailwind from beauty will fade. Sephora had been a bright spot for Kohl's, but the analyst is also concerned that the retailer will have to cut its dividend next year if sales don't improve quickly. Matt.
All right, excellent roundup of morning calls there. Let's talk about computers. It appears a new computer was not on Santa's early shopping list. Dell and HP results show the long-awaited recovery of the personal PC market is stalling. Both stocks down sharply today. Here with more is Bloomberg Technology co-host Carolyn Hyde. And I guess, the AI piece hasn't really hit computer sales yet.
You haven't rushed off to buy a new AI PC?
I haven't bought a Mac since 2014.
I think the question is, what is a generative AI-infused computer going to do for your life? Not many people have really been able to understand that, so yet we're seeing a hold-off in HP PCs, in Dell PCs. There's a softening there, and so revenues actually didn't look that bad for HP in this fiscal quarter, but the forward-looking guidance, the forecast, showing that this festive season is not going to be a hot one for its hardware. Then you look at Dell, and they're all about AI servers. That's why everyone got so exuberant. And actually, you saw about 58% pickup in that part of the business in terms of sales. That seems healthy. But the market was ahead of that. This was a stock that had run up more than 80% coming into these earnings in this year alone. So everyone had already baked in the exuberance around the Blackwell system from NVIDIA, which, of course, is what is housed within the Dell server business. And remember, this isn't a particularly high-margin business if you're just making sort of the gear that wraps around the very expensive chips. Same, too, with HP. There's some worry around their margins because actually some of the commodity costs are going up. And the prices, are they going to come down if China and U.S. tensions get higher?
Yeah, a lot of big questions there. And I mean, focusing just in on the PC business, that upgrade cycle that it seems like we're all waiting for being pushed forward into the future, it kind of reminds me of the iPhone upgrade cycle that we've also been waiting for that refresh to come. And it hasn't quite materialized yet. Is it fair to draw those parallels?
Well, look at the IDC numbers today showing that actually smartphone growth was pretty healthy. We rebounded, but it's Androids that are doing well. It's Chinese demand that's doing well. Apple not managing to ramp up its actual revenue or sales growth, but maybe its profitability is still looking good because the average selling prices are going up. Maybe that's sort of a question that we're eventually going to see is that, look, we refresh our PCs fewer, but they're going to be more expensive. They're going to generate more margin in the longer term. But at the moment, we're not seeing that for HP, and they're going to have to talk around how those components start to drop in price. The CEO did try to signal that, but people aren't really buying it if you are going to see these trade tensions and tariffs that start to impact companies that get their supply chain from China.
I imagine it's a different cohort also, right? Because consumers, individuals buy iPhones, whereas companies buy PCs.
That's
like a regular person isn't going to go out and buy a PC unless he's given up on life.
But people run businesses too, and they might say, the people in charge of the business, wow, we got to get our hands on these new AI PCs. They're going to be so much better.
Everyone refreshed during COVID, 2021. This Microsoft Windows 11 shift, that hasn't materialized either. And so I think there's a lot of business confidence that needs to be built. And messaging. Look, we need to be marketed harder about the reason that I need an AI PC rather than just running generative AI on my smartphone or at the edge.
All right. It's, I think, a story that's to be continued because when they do come out with real innovation for which you need a new PC, obviously we're all going to rush out Mac or PC. We're all going to run out and get a new computer, right?
Maybe.
I'm sure.
Watch this space.
Yeah, Caroline, thanks so much for joining us. Carolyn Hyde there, anchors Bloomberg Technology. That show coming up at 11 o'clock, so an hour and 12 minutes from now. Coming up on this program, Texas leads a number of states accusing big money managers of breaking antitrust law with their ESG practices. That's next in our Wall Street Beat. This is Bloomberg.
All right, welcome back to Bloomberg Open Interest. Let's take a look at stocks about 21 minutes into this U.S. trading session. As you might expect it, the day before Thanksgiving, volume has absolutely fallen off a cliff. Relative to our 20-day average, trading volume is 25% lower right now, and you can see that in the price action. The S&P 500 down a hair, 0.1%, a little bit more if you take a look at the NASDAQ 100. Losses accelerating there, actually, down about 0.6% on your big tech benchmark. And then you take a look at the Russell 2000, and finally we have some good news. The small caps extending their gains right now, up about 0.9%.
All right, let's get to the latest Texas story. That state and 10 others are accusing money managers, including BlackRock, Vanguard, and State Street, of breaking antitrust law. They allege that the firms boosted electricity prices through their investments, but also their clout and kind of discouraging more coal production. It's the highest profile lawsuit yet against the beleaguered ESG movement. Bloomberg's Sally Bakewell has the details, and she joins us now. So, Sally, this is, I mean, first of all, it's a little bit difficult to wrap your head around. So what these states are saying is that BlackRock and Vanguard and State Street, they're so woke and they're so big and powerful that those two things alone have discouraged coal production?
Essentially, I think so, yes. The lawsuit alleges that BlackRock, Vanguard, and State Street used their shareholdings in coal companies like Peabody Energy, Arch Resources, to actually push management to cut their carbon emissions. And they say that this started around 2021 as part of these firms' membership of climate groups like Climate Action 100 and Net Zero Asset Managers Initiative. Now, this is just a very challenging and fraught area because the term ESG was much hyped by Wall Street and banks and investment firms, with often BlackRock at the forefront, went all in. But then the firms, they found themselves in this sort of reputational and political conundrum when the label came under fire and attacked by Republican politicians. So a lot of them have spent the years since 2021, when it was really at its peak, scrubbing that name from investment products and dialing back their efforts.
Yeah, I mean, to that point, the states that we're talking about here, including Texas, it's West Virginia, it's Montana, so Republican-led states. And you mentioned that BlackRock in particular, Larry Fink in particular, has backed away from that ESG label. And like Matt said, this is a pretty difficult case to wrap your mind around. You explained it well, but where does it potentially go from here?
Well, I think what the companies would argue is that they always act in their best clients' interests. They vote in line with the underlying companies. It's rare that they break with management. And they would also say that, while they engage with companies over a few years to get their views across, they do not dictate strategy. And BlackRock indeed has faced a fair few legal warnings from Republican-led states over environmental, social, and governance factors. Mississippi state officials accused the investment firm earlier this year of making fraudulent statements regarding to its climate strategy in March. And BlackRock, in response, it said, it operates in a very highly regulated industry and is committed to following the law. But I think we can see the mood music since has shown the likes of Larry Fink sort of making sure he's forming sort of the alliances with the industry, and other companies have pulled back. JP Morgan Asset Management and State Street Global, for example, they said in February that they were withdrawing from one of these climate action groups.
All right, Sally, great reporting. It's a fascinating story, and I recommend everyone go on the terminal or Bloomberg.com to check it out. Sally Bakewell, they are talking about the new Texas suit against BlackRock, Vanguard, and State Street. Now, I just want to point out, we've been following the Pony AI IPO. The shares in that IPO priced at $13. They haven't started trading yet, but pricing is indicated at about $15 a share.
A little bit of a premium there.
Yeah, that's what you want, a little bit of a pop. Not too much, because then you left money on the table, and not none, because then investors aren't left wanting more.
And all told, that should give it a market cap between $4.5 to $5 billion. We'll continue to follow that one. And coming up in the next hour, we've got a great lineup. Yeah, Anwiti Bahuguna from Northern Trust talks about her Buy America tactical call for equities. Then the points guy, Brian Kelly, joins us to talk about Thanksgiving travel. Should be the most traveled weekend of all time. And plus, we're going to get to talk to Whitney Tilson. He's running for mayor on this program. This is Bloomberg. We are 30 minutes into this trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller. And I'm Katie Greifeld. Sonali Basak is off today. And let's take a look at these markets. Like Matt said, 30 minutes into this trading day, it's pretty quiet right now. The S&P 500 down about 0.1%. We might get a little bit more action because we do have some breaking data crossing the terminal right now in the form of PCE. We got some numbers earlier at 8:30. Now a little bit more details here. Let's turn it over to Bloomberg's Michael McKee. He is sitting to my left. What did we just learn?
We just learned that inflation is stalled out above 2%. It is exactly what economists thought it would be. Disappointing Matt Miller, who was looking for chaos. 0.2 rise in in the headline PCE for the month of October, and that puts us at 2.3 for year over year, and a 0.3 rise in the core, 2.8% year over year. And both of those are increases over where we were. That chart probably hasn't refreshed yet with the latest data. But the point is we are not moving closer to 2%, which is what, of course, the Fed is looking for us to do. Personal income comes in up 0.6%. I'm going to look at the numbers behind that and see how much of it is wages. Personal spending 0.4, which is as expected as well. Last month was 0.5. So in October,
here you go, Mike. They've refreshed your chart.
There you go. And you can see what happened there. The yellow is the super core. That hasn't come across yet. But the rest of it is all as expected, which feeds that kind of Fed pause narrative if you want to go there.
So I'm not rooting for chaos. I just want these numbers to reflect how I feel personally about prices.
The prices are too high.
Too high.
I would imagine. Well, there's the saying is basically that if prices are too high, it's because somebody is raising prices on you, and that's not fair. But if your income is above the price rise, which it looks like it has again done, that's because you are brilliant and you have deserved a big raise.
I mean, I agree with the very last point, Michael McKee. Thank you so much for joining us. Mike McKee there, our economics and policy editor. Joining us now is Anwiti Bahuguna, Northern Trust Asset Management CIO of Global Asset Allocation. Anwiti, thanks so much for sticking with us on this Wednesday before Thanksgiving. Happy Thanksgiving to you. I'm looking at not prices in terms of goods that we need, but prices in terms of the markets. And I'm seeing so much exuberance here. I mean, the Conference Board's survey showing that expectations are for even higher prices. The chart is 1977. If we want to pull that up, it's just mind-boggling that no one thinks stocks go down anymore, even though we're trading at a total market cap that's more than twice the U.S. GDP. Do we continue to go in this direction?
Morning, Matt, and happy Thanksgiving to you too. Thank you for having me. I think if you look our outlook for the next year or so, our expectations are very much with the economic momentum that you currently see, that also Mike McKee just pointed out. We continue to see better growth than expected. In fact, Matt, even factoring in better growth numbers, if you look at economic surprises in the US, they still are coming out positive. In other words, even with high expectations, the actual numbers continue to surprise on the upside on economic data. So as long as we have strong economic momentum, and that translates into better earnings, which is our expectations for next year, I would say that the exuberance you see in the market is actually very much reflective of the fundamentals.
So following on with that you're following the economic growth, there was a really interesting note out from Bank of America yesterday talking about this cyclical inferno that they're expecting. And as such, they're overweight financials, consumer discretionary, materials, real estate, utilities, the list goes on. Basically, because of that they also expect strong economic growth. When you dial down to the sector level, where does that leave you?
So broadly, our analysts favor still the cyclicals that you mentioned. Energy, materials, technology continue to be strong performers in their book. I think one thing I would point out is that as an asset allocator, I'm also focused on the second bit of data that Mike mentioned, which is what's happening to prices. I think it's important to keep an eye on that. The inflation data of late, in the last 3 months, the momentum's turned on the upside. In other words, we are seeing a stalling of that decline in prices to higher levels than expected. So, Katie, that to us as an asset allocator is a risk we very much want to be focused on, because that does bring that Fed pause into question. That does bring into discussion what's the neutral rate of interest, and do we see some monetary pace, slowing down, not easing as much, which may not have been factored into the market equation. And that's something we need to keep an eye on, because even if fundamentals are good, that can have very strong impact on sentiment, which then translates into valuation fears.
You know, a couple of days ago, I got a message from Mike McKee, and the subject header was, want to see something cool? And I clicked into it, and it was DOTS Go. So on the Bloomberg terminal, you can type DOTTS Go, and you'll see the Fed expectations, what the Fed participants say. This chart doesn't have the projection in it, but the market is looking at more like 4%, and the Fed is forecasting less than 3% in terms of the terminal rate. How is that divergence going to be, solved at the end of the day?
That's right. That is a divergence that I'm very focused on. So if you think through the scenarios that we have in our projections, right, our base case matters that growth will slow down, inflation will come down. But there are two risk cases that we highlight, which are tail risks. One is positive for growth, but inflation stays sticky. The other is actually negative for growth, and inflation stays sticky. So in all the scenarios, we see inflation actually being higher than what Fed's projecting. And that does translate into this disconnect between how much they would ease versus what the market's expecting. And we still expect our base case to come through, which is that inflation does come down, but those are very much tail risks that we are focused on. Our contention is that the neutral is higher than what the Fed stated, but that remains to see. We are very focused on watching that play out.
So it's not your base case, but let's talk about that tail risk and where in the market those tails are the biggest. You think about where sort of these Fed cuts have been priced in. You can make the case that you're seeing that pricing in coming strongly in the small cap sector, that a lot of those companies need rates to come down. So if that tail risk did come to fruition, where would it hurt the most?
I would say, Katie, it would hurt most in the bond market because composition of the economy is still of strong revenue growth, which is, and by the way, another thing we didn't bring into the forefront was the deregulatory environment. All that's very supportive of small caps. That's supportive of M&A activity. So there is the tailwind from regulation and deregulation and tax cuts, but the risk is of inflation being higher. And there, I think the risk is more on, very clearly, the first order risk is what happens to bonds. We are underweight bonds in our asset allocation portfolios. Now, the second derivative risk might be in some of the companies that rely heavily on funding. But then it's a matter of magnitude. Is it 4 cuts? Is it 6 cuts? Do we need 6 to feel really good about small caps? No, we are actually already very much in favor of small caps.
Anwiti, how much is higher inflation really a problem? I mean, we're all banking on reduced regulations. We're all banking on continued tax cuts or even further tax cuts. But it seems that market participants with whom I talk, especially those who are, pro-Trump, dismiss inflation concerns outright. Is that just because stocks are a great hedge against inflation, so they think those assets will be higher anyway?
So again, Matt, that's an excellent question on magnitudes. It does matter how much inflation rises or sticks to, and inflation is very much a tail risk. It is something market participants should very much be aware of. We have noted in our analytics and looking at historical data that around 4% it's still okay for bonds. Beyond that, it very much brings into the question of Fed action, and valuations start reflecting that. Right now, the magnitude between 2.5 to 3, it's not that much of a problem. And I would say that, it's a risk very much to keep within your analysis.
All right, Anwiti, really appreciate you joining us. That is Anwiti Bahuguna of Northern Trust Asset Management. Let's get to take a look at these stocks moving ahead, or rather 30 or so minutes after the opening bell. Here's Abigail Doolittle.
We have some outsized movers beneath the relatively benign surface, starting off with the shares of Dell Technologies down more than 10%. The worst day, in fact, since late May. They missed sales on a stalling PC recovery. In addition, even after this decline, this stock up about 65% or more on the year. So richly valued. Investors wanted more out of the quarter and guidance, and they just didn't quite get it. Turning to the shares of Urban Outfitters, a very nice rally, up 13.5% at this point. They beat adjusted earnings estimates by 28%, putting up $1.01 on about $1.4 billion, a little bit less than $1.4 billion. But that was a 2% beat relative to estimates. So they've really defied the retail woes, investors rewarding those shares. And then finally, we have the shares of Symbotic, an automation technology company, absolutely plunging down 37%. They are cutting their sales outlook due to an accounting error. Matt, there is also a 27% short interest on this. So it seems as though some of those bears prepared for the possibility of something negative here, and on that, we certainly have this stock down in a massive way.
Yeah, down more than 53% year to date. And I know why you paused, because it should be symbiotic, right? And it's hard to read that because they're missing that I. I'm not suggesting that has anything to do with the poor performance in markets. Abigail Doolittle, thanks very much for that. Coming up, Donald Trump's plans to ramp up tariffs gain more momentum with his latest cabinet picks. More on the politics that could affect these markets next. This is Bloomberg. Let's get out of high interest. Look at what's making headlines around the world. The head of one of the world's biggest trading firms says it's time to scrap the SEC and the CFTC. Don Wilson, founder of trading powerhouse DRW Holdings, told Bloomberg it's time to just start from scratch. He says the friction between both regulatory bodies is counterproductive. Wilson's firm is currently in a legal battle with the Securities and Exchange Commission. Consumers in the U.S. are set to face significant consequences from President-elect Donald Trump's proposed tariffs on Canada. That's according to Goldman Sachs. The bank's head of commodity research says the 25% levy would raise fuel prices in the U.S. as the country imports almost 4 million barrels of Canadian crude a day. And Donald Trump's economic team is taking shape. The president-elect picked Kevin Hassett to direct the National Economic Council and named Jamieson Greer as the U.S. trade representative. The announcements come a day after Trump vowed to impose those additional tariffs on China, Canada, and Mexico. Katie?
Well, for more on Trump, trade, and tariffs, I'm pleased to say we're joined now by Bloomberg's Mike Shepard, joining us from Washington. So let's talk through some of these appointments in the context of the tariff proposals that were announced earlier this week. You think about Jamieson Greer in particular, a protege of Robert Lighthizer. What does that say about the tariffs that were proposed and whether or not they actually will go through?
Well, Katie, the way to look at it is that Donald Trump really does mean business when it comes to his approach to trade, and that is to use tariffs to extract concessions and to try to bring more manufacturing back to the U.S. But we're also seeing Trump try to deploy tariffs in another way, and that is to extract policy concessions as well. And that was the signal that we were to take from his Truth Social posts on Monday, threatening China, Mexico, and Canada, the top 3 U.S. trading partners, with tariffs over policy questions around the border and drugs. Now, in Jamieson Greer, we see somebody who really does buy into the idea of tariffs, and he also has a much tougher approach toward China than we're seeing now with the current administration.
So in terms of these tariffs, I think a lot of people, Goldman Sachs, as I just noted, are shocked that they're so high on our NAFTA trading partners. I mean, President Trump has proclaimed NAFTA as the greatest trade deal of all time. And is the idea, you think, just that, he wants us to make more of this stuff here? Besant says 333. Part of that is 3 million barrels of oil. So maybe we don't need 4 million barrels of crude from Canada a day.
Yes, that's in part what they are looking to do. But there is another element, and this is specifically the China portion that we should talk about when we think about Jamieson Greer's selection as trade chief. He is really a China hawk, and he even stands out in Washington for the severity of his positions in a way. He is somebody who sees China as a generational challenge, and he is also favored what is called a strategic decoupling from China. Now, that would be far more than the current administration's current trade chiefs. That would be Catherine Tai, the U.S. Trade Representative under Biden, and Commerce Secretary Gina Raimondo. They have shied away from using that language, even as the Biden administration has continued the Trump tariffs on Chinese goods and also imposed export controls of its own. Now, Greer would take those a step further, and he would favor putting even more controls on exports of sensitive technologies in other areas besides semiconductors and artificial intelligence, but also aviation goods and transportation equipment to China to try to prevent them from gaining an edge there. And he's even talked about revoking China's permanent normal trade relations status. And this is something that was afforded to Beijing all the way back in 2000 when China was trying to enter the World Trade Organization. That would be a significant step and put China back in the same category as Russia, Cuba, and North Korea.
It'll be interesting to hear from China, their response to that, too. Strategically decoupling from the third largest trading partner of the United States certainly seems like a tall order. But that's the tariff piece. Let's talk about the tax piece, because you think about Kevin Hassett, of course, he is no stranger. He was the chair, actually, of the Council of Economic Advisors. What do we know about him and what he might look like in the second Donald Trump administration?
He was a Bloomberg opinion contributor for a long time.
That's true. He has a decorated resume.
He was a contributor? Yes, and he has that familiarity with Trump to know what the president-elect will want once he takes office. And those tax cuts, again, when you talk about meaning business, Trump is serious about lowering corporate rates to 15% from the current 21%, but then also making good on his promise to deliver tax relief in areas such as tipped income, Social Security income, and other kinds of income that he promised during the campaign. Now, it will be up to Kevin Hassett, together with the Treasury Secretary nominee, Scott Bessent, to negotiate all of that with Congress. And lawmakers, while many Republicans will buy into these changes, they are also going to be eyeing what this means for the U.S. balance sheet and deficit. So there will be a lot of haggling. Getting any kind of tax legislation through Congress is a long slog, and the challenge will be that Donald Trump is not the most patient president or person for that matter.
All right, Shep, I hope that we have, though, gotten enough headlines from the president-elect that you'll be able to relax and eat some turkey and watch some football over this Thanksgiving break. Mike Shepard there, coming to us from Washington, D.C. Still ahead, Taylor Swift's Epic World Tour is now entering its Target era. Details next. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Apple missing out on the smartphone rebound. A new study highlights a strong year for global smartphone sales. That's after 2 consecutive years of declines. But Apple, however, it barely managed any growth, which really underscores the speed by which Android-based rivals are gaining ground in China and other emerging markets. Next up, many Starbucks corporate workers are only getting 60% of their overall bonuses for the company's most recent fiscal year. That's thanks to the coffee chain's poor financial performance. Meanwhile, coffee as a commodity is getting more expensive. Arabica beans are now at their highest level since 1977. And finally, Taylor Swift's The Eras Tour book will go on sale exclusively at Target stores starting this Friday and on its website on Saturday. Target has the exclusive rights, Matt, to the book that it's retailing for around $40. It's self-published by Swift through Taylor Swift Publications rather than through a traditional book publisher. That's pretty interesting. I don't know.
Isn't Taylor Swift like on top of her game?
Yeah, she is. I actually just saw her this past weekend in Toronto. It was insane, just to put it mildly.
The juxtaposition of that success with like the dirty floors and fluorescent lights of Target.
That's true. It
seems like That's not heading uphill, right?
It's a bit out of sync. I will say $40 though for a book is pretty pricey, so you're gonna have to pay up, and probably looks really nice, but I don't know. I just saw her, so I probably won't be buying the book, but I don't know. You can find it exclusively at Target. Should we talk about the markets really quickly here? We have like an hour into the trading session. You can see that the losses are deepening for big tech. The NASDAQ 100 down about 1%. The S&P 500 managing to outperform that, but still down about 0.2%. A little bit of a bid coming into the bond market. Coming up, we'll talk about Americans hitting the road. The points guy joins us next. This is Bloomberg. Well, the TSA says that a major stress test is coming to the airlines this Thanksgiving, with over 18 million people expected to travel for the holiday. That is according to the agency, and that would be an all-time high for Turkey Day. For more on holiday travel, I'm pleased to say we're joined now by Brian Kelly. He is the founder of The Points Guy. So an all-time high, a record day of travel expected. Can the TSA and the American airline industry actually handle it?
Well, the TSA, I'm not worried about. They're staffed up and ready to go. The issue we should all be looking at is the FAA. So air traffic controllers, there is a shortage. We've known there's been a shortage for years. The Department of Transportation has said they're in the works towards backfilling those positions, but there are certain places like Newark. Yesterday, Newark had a ground stop, not because of weather, but largely because of air traffic controllers and staffing issues. So in general, our air traffic control network in the United States is way behind our industrialized peers, very manual process, very dependent on humans, and there's just a huge backlog. So that could be a thorn in our side. Plus this weather system, as we all know, weather systems can upend the entire air traffic system. So far it's looking good today, but definitely keeping my eyes on it.
That pilot had a sweet mustache in the VO that we were showing.
It was good television.
You got to trust a pilot with a good mustache. I wonder about the Permanent Subcommittee on Investigations, Brian. You may have seen that Richard Blumenthal said their investigation in Congress found that airlines use algorithms to set seat fees, and they can change based on the flight, but also the passenger. Have you heard of that before? It seems insane.
Well, you know, this is really interesting, and you can't blame the airline industry. I think every industry is starting to use advanced algorithms to target consumers on social media. I know, you know, because Instagram knows my profile and the type of clothes I buy, I know I'm getting served certain ads. I'm like, I think these same pieces of clothing are probably being offered to other people for less. So I think that's a trend that's going to go on in every industry. Delta actually in their investor day recently announced something even more potentially concerning for consumers, is that they're currently testing 1% of their airfares. They have an Israeli startup called Fetcher that's doing dynamic AI-driven pricing. And when I went on the Fetcher's website and tried to look around, basically they're trying to do just that, understand who each individual air purchaser is, and instead of serving one fare to everyone, that they will use AI, and I'm sure the treasure trove of data they have on consumers. So if they know you've got more money, could they be serving you higher fares? Delta didn't disclose exactly what this test is, but they've said it's been very successful, meaning they're extracting more money from each and every person buying tickets.
Yeah, it'll be fascinating to see what comes of that. I do want to switch gears a little bit and talk a little bit more about Delta. You mentioned them, and I interviewed the CEO of Delta alongside Tim Stenovic, along with the CEO of Wheels Up, which is this private aviation company. They have a partnership, Delta and Wheels Up, and I think it's a really interesting model and an interesting sign of the times that Delta is trying to maybe get a little bit deeper or be more exposed to what's going on with private jets right now. What do you make of that dynamic?
Yeah, well, Delta bailed Wheels Up out. Wheels Up was in a tough position. Most of those private jet startups have failed miserably. You know, at the top end of the spectrum, the net jets have done extremely well, and the super premium private jet space, that industry is booming. But trying to get premium consumers who are used to paying $1,000 for a domestic first-class flight, and it's interesting because Delta is the most on-time airline. So in my opinion, if there was an airline to team up with Wheels Up, it would be one of the less reliable major airlines out there. But there needs to be a bigger integration and education, I think, because the gap is still so wide, even between getting a small Wheels Up propeller jet. And there's really not that much integration. If you buy Wheels Up packages, you can earn Delta Elite miles, but it's, in my opinion, still a pretty loose integration. And I think Delta needs to do a little bit more to say, hey, look, these flights might be canceled. You can book a Wheels Up instead. That could be revolutionary, but I haven't seen anything that innovative happening with the partnership.
Yeah, we'll see how it evolves. I mean, Delta owns close to 40% of Wheels Up, but Ed Bastian was clear that he doesn't want to own the company completely. I know that Matt has a ton more questions, but I want to sneak in a question on JSX, which is an interesting concept, of course. There's other people on the flight. It's a charter jet, but you go to a private airport, such as a Morristown. You get on, you skip, the typical rigmarole of the security line that you would get at Newark, and then you get on a flight with, 30 to 40 other people, and it takes you to your destination. What do you think of that model? Do you think that it's viable?
JSX is interesting because it's not quite a private jet. When you get on the plane, it's sort of like a little bit of a more roomy regional jet. But as you mentioned, the key selling point is avoiding the big terminals. You can go and fly pretty much semi-private. They're also amazing with dogs. So I know a lot of my friends who have dogs who do not want to check them in the hold, fly JSX because of that. Their route network's a little wonky. They don't have those nonstop coast-to-coast flights. I have friends who fly from the coast and they have to stop in Dallas, which is not exactly ideal. And it's not really that premium of an experience. I find ExoJet pretty interesting because that's a service that flies beautiful private jets between Florida and New York and to places like Aspen and the West Coast. And that you're getting that private jet terminal experience, but you're also getting a big, nice seat on a big private jet for not that much more than a first-class ticket on airfare. I mean, still probably double, $2,500 New York to Miami, but that's doable versus renting your own Wheels Up jet for $20,000. I think most people would say, hey, I'll do $2,500 for me and my spouse, $5,000 total, versus getting my own small jet, which just doesn't make that much financial sense.
Katie, you have a hairless cat.
I do.
Named Catrick.
I do.
And you're not allowed to bring the cat on bark. I feel like that's obvious, right?
Yeah.
You can't bring a cat on a dog airline.
They discriminate, but they can fly on JSX.
On JSX, that's interesting. So I have a bunch of questions. Brian, my wife writes in and asks, she's like, oh my God, you have the points guy. What's the best search engine to find award tickets across multiple partners?
Yeah, so Point.me, I think, is the industry leader because it's point.me. And if you have an American Express card, it's free. Point.me/Amex. And it'll tell you which of those Amex transfer partners you can transfer your points to. And the key here is it actually links up with airlines. So it'll tell you what's available. As we all know, with credit card points, if you try to buy business class tickets, it's usually 1 cent per point in value. Not that great. But if you can figure out transferring your Chase, Amex, Capital One points to partners, you can fly for a fraction of the cost. So yeah, there's a couple of other ones out there. Roam, ROAME.travel is another one of these search engines. But I think Point.me is the industry leader. They're also integrated. If you have the Built card in the Built app, it'll let you use Point.me for free.
Awesome. Brian, great having you on the program. Thanks so much for joining us. Brian Kelly, there, the points guy, talking to us about travel in, I believe, what's going to be the busiest weekend of any season.
That's what the TSA is saying.
Of ever.
Yeah.
So interesting stuff. Let's get a check on what's going on in the markets right now. For that, we go back over to Bloomberg's Abigail Doolittle. Abby, what have you got?
We're looking at a bit of a sell-off here for stocks. Take a look at the NASDAQ 100 down 1.2%. Last time I checked, but this index is moving down somewhat rapidly, so it may be further back. The worst day in about 2 weeks. We'll be taking a look at a big reason why in a moment, but clearly big tech weighing there. You can also see that yields are lower, signaling that there's a bit of a rally for bonds amid the PCE coming in at 2.8%. That may support the Fed there being no rush to cut rates. But right now, a bit of a rally there, so a bit of a risk-off tone. And then when we add into it the yen rallying against the dollar, this is the big one, down 1% at the lows for the dollar yen. It was the best day for the yen since September 27th. And of course, when the yen itself goes higher, the dollar yen goes lower, all of this pressuring stocks. So that could be a big piece of it for the NASDAQ 100. We're also seeing it in the volatility measures for the FX space. Take a look at the JP Morgan currency VIX, essentially. They're much more elevated than the VIX itself in white, and then the bond index, the MOVE index, the VIX for bonds. Currencies, a foundational asset class. Sometimes when the volatility starts there, it will then ripple through to bonds and stocks. So stay tuned for the month of December. And I should note that NASDAQ 100 right now heading to a down week. And some of the movers that we're going to see, not just for the NASDAQ 100, but the S&P 500 and other index. Hims and Hers Health, that's up 2.3%, but it had been higher at a record high. MicroStrategy holding on to its gain, up 9.6%. This is Bitcoin is up 3%. Take a look at NVIDIA, though. This is the big one, and why we have the NASDAQ 100 down so much, also dragging on other big tech, down 3.3%. And there are some sources saying that NVIDIA and Intel suppliers are reevaluating their manufacturing strategy in Mexico due to the threat of tariffs. So just the idea of reworking things, Katie, sending those shares lower. And then, of course, Dell is lower, down 13%, the worst day since May of 31st of this year. They missed their sales estimate slightly by less than 1%, but investors are a little bit worried by the slump in PC sales.
Yeah, a lot of big moves in thin liquidity. Bloomberg's Abigail Doodle, thank you so much. Now, coming up, a new player has entered the race for New York City mayor. We'll speak with former hedge fund manager Whitney Tilson about his plans next. This is Bloomberg.
All right, Whitney Tilson is entering the crowded field of Democrats seeking to succeed Eric Adams as New York City mayor. The former head of Case Capital has said his top priorities include cutting violent crime, addressing the high cost of housing, and improving city schools, a project that he's been working on for decades. He joins us now. Whitney, thanks so much for your time. I wonder about first and foremost, the immigration issue that we have ever since Governor Abbott started shipping immigrants to this sanctuary city. It seems as though we've spent so much money on that group of people that we haven't had enough money to boost our police force or expand the universal pre-kindergarten program. Would you roll back our sanctuary city status as mayor?
In part, you have to, if you look at the long history, there's actually been a sanctuary city status in New York for many decades, and it has been implemented by even Republican mayors like Giuliani going way back. But where we went awry, and this is really a great example of, my campaign as a lifelong Democrat running as a centrist Democrat against the radical left that is in a one-party dominated city like New York has sort of hijacked our city and taken us too far to the left. We passed additional sanctuary city legislation in 2018 that basically made it impossible for local law enforcement, if they, for example, arrested someone who committed a violent offense, let's say they're a Venezuelan gang member. This, in fact, happened last week, and it was the 7th time this guy's been arrested this year. And this is crazy. On his first arrest, local police should have turned him over to ICE, and they should have deported him on the next plane to Venezuela, obviously. And because of this crazy legislation that went much too far back in 2018, New Yorkers, it's contributing to the violent crime spike here in New York. So I'm going to roll back the sanctuary city back to the way it was, for decades, where, I have no interest in helping the Trump administration try and deport 12 million illegal immigrants who mostly have been here for quite a while and are hardworking and contribute to our economy and aren't committing any crimes. Let's focus on the dangerous ones and get them out.
How do you run as a Democrat then, Whitney? Because it seems as though that party on the left has dismissed the narrative that any of these immigrants cause a spike in violent crime. And yet, here in New York, you've definitely seen crime run unchecked. The police haven't really been able to do much about it. And the homeless and drug addiction problem seems worse than ever as well.
Yeah, it's a big problem. Only 37% of New Yorkers surveyed say that they believe their neighborhood is safe. That's down from 50% in 2017. And that is reflecting the reality that since crime bottomed either just before the first year of COVID, when everybody was shut down, sitting at home, crime has spiked back up. Nothing like it was when I first moved to New York 31 years ago. But it's definitely crime and disorder are up, and people are voting with their feet. We've lost 500,000 people, 6% of our population, the second worst of any large city in the country since the year 2000. So I agree with the majority of New Yorkers. The city is heading in the wrong direction, and that's why I'm stepping forward to turn it around and be a centrist, business-oriented Democrat like your founder, Mayor Bloomberg, was. And look what's happened to the city in the 11 years since career politicians got in and have been screwing it up.
Well, Whitney, let's take this conversation specifically to the subways, because crime and safety on the subway is obviously top of mind for many New Yorkers. And we talked about this a little bit, but what specifically is your plan when it comes to the unhoused, the mentally ill, getting them safely off the subways?
Yeah, and it's not just the subways, of course, it's out in our streets as well. Big picture, if I were to summarize my plan to reduce violent crime by 50%, and I'm pledging to New York voters, if I don't do that, vote me out in 4 years, is big picture, 6 words: let police do their frickin' job. And they want to do it, and we've tied their hands. The 3 words that are the antithesis of my plan is defund the police, the 3 dumbest words of all time, and that embodies the radical left views on this. So it is homelessness in general, mental illness. It's a big issue. And if we had an hour to talk about it, I'd love to dive into the weeds. But basically, we need to reform the bail law that I was actually initially an advocate for, but ended up opposing, that passed in 2019, that ties judges' hands. So you get a revolving door of putting dangerous people back out onto the street. As I mentioned earlier, we need to reform the sanctuary city law to the extent any of these folks are in this country illegally and causing mayhem. They should be on the next flight home to where they came from. And most importantly, 50% of violent crime in this city occurs in only 3.5% of the city blocks. Violent crime particularly, which is what really matters, tends to be very localized, and it's localized in the subway system as well. It is not random. So you have to identify the concentrated hotspots, and you flood the zone. You declare a state of emergency in areas in which the local community is being terrorized, and work with the local community. And instead of defunding the police, I want to double down and put more police in the neighborhood, not as an occupying force, but working in collaboration with the law-abiding citizens in those areas everybody knows who the bad guys are. Everybody knows who's dealing drugs and where they're dealing drugs. It's happening right now in Washington Square Park as an open-air drug market. That's a disgrace.
Whitney, we don't have much time left. I want to talk about something other than crime, and I want to talk about the trend that has been developing over the course of decades. But you have the city's richest people moving to Florida, and I think Eric Adams actually once said that he would go to Palm Beach and get them back. Is that something that is a priority for you, having that tide reverse of wealthy people leaving the city and eroding the tax base?
Yes, absolutely. I mean, here's a shocking statistic for you. So big picture, it's not just rich people. The vast majority of the people leaving New York City, the 500,000 people we've lost since 2000, are working class people who simply are fed up with crime and disorder, and they can't afford to live here. But keep in mind, 1% of our taxpayers, the richest 1% of New Yorkers, pay half the city's income taxes. So it's devastating financially to our tax base and funding everything. We're a very high cost city, of course, when those folks are moving. I know a lot of those folks, and they're fed up with the same things that middle class people are fed up with. Since 1970, New York State has lost 13 House seats due to people leaving the state. A lot of that's in New York City. Guess how many seats since 1970 Florida has gained? 13. This is not a coincidence, and it's not just due to sunny weather. We Democrats in blue cities and blue states that we've controlled have not been managing them very well. People are voting with their feet, and I'm determined to reverse that, at least in my hometown.
You know, one of the big problems for New Yorkers has been the cost. It's difficult to keep up with, housing costs. I think the average rent is about $4,500 across Manhattan. Those costs have increased about 10% this year, about 30% since 2019. And of course, high taxes play a huge part in that as well. It must make Florida look pretty appetizing. What you can get in Florida for $4,500 a month is fantastic, and then no income taxes on top of it. How do you plan to change that?
Yes, I mean, look, after crime, disorder, and safety, the number one issue New Yorkers are concerned about is the unaffordable cost of living, and the biggest piece of that is, of course, housing. And look, I'm the only business person in the race. It's a crowded field of all career politicians, with one exception: one business person, one person who can bring a completely fresh perspective. And my appeal is bypassing the Democratic Party machine, going straight to the voters and saying, if you want change, I'm the only change agent in the race. Housing is going to be a big piece of it. I'm probably the only guy in the race that understands supply and demand. The reason housing is so expensive in New York is we have a 1.4% vacancy rate, because a lot of people still want to live in New York, but nobody can build any new housing. The City Council just last week passed a watered-down bill that eases some of the ridiculous zoning regulations. Again, that the sort of radical lefties took a good idea, which I support, which is sensible zoning. They went way too far and make it impossible to build any new supply. Hence, prices have been soaring out of control. So I'm going to push super hard to take what the City Council passed last week, and we need to do double or triple that to ease the regulatory burden and zoning restrictions that make it impossible to build new housing, get a lot of new housing built, and that will bring down costs.
All right, Whitney, not enough time. Hope to continue this conversation soon. Really appreciate you making some time for us. That, of course, is Whitney Tilson running for New York City mayor. And, of course, Mike Bloomberg is the owner of Bloomberg News. He served 3 terms as mayor from 2002 through 2013. Meanwhile, switching gears, Thanksgiving is tomorrow, and dinner may actually be cheaper this year. The latest data shows that prices for turkey are dropping even as supplies grow tighter. Here to talk about our Thanksgiving Day spread is Bloomberg food reporter Dina Shanker. And this is interesting. It's a bit unintuitive. Unpack some of this data for us.
Yeah, so of course we all hear about the higher grocery prices, but Thanksgiving is looking like it's going to be about 5% less expensive to make this year, according to the American Farm Bureau. And a big part of that is lower turkey prices. So turkey prices are at their lowest level since 1985, even as supplies are also really low. And so what that tells us is that people are just buying less turkey. Demand is lower, but they're not going to serve turkey. It's Thanksgiving. There's going to be plenty of turkey available on the tables. A lot of people are buying turkey breasts and turkey legs instead of whole turkeys.
Actually, my buddy Matt Padgett bailed on turkeys this year. He's
Really?
doing fried chicken, but I think he's an abnormality. Obviously, turkey is traditional. What else are you tracking the prices of? Are we looking at cranberry sauce, stuffing, mashed potatoes? What's the list comprised?
So there are all kinds of reports out there that are looking at basically anything you could put on your Thanksgiving table. And one of the big takeaways is that almost always the store brand is going to be less than the national brand, which is not surprising to anybody that has been at a supermarket lately. And we're seeing a lot.
So you're saying Kirkland or Bowl and Basket rather than?
Yes, exactly. And so these are things that people have been doing for a long time now. American shoppers have gotten really good at finding the best deals. We've been reducing the amount of waste, which may tell us something about why people are buying breasts and legs.
Right.
And people are doing a lot of potlucks this year. One person I spoke to said for her garnishes, she's going to stick with parsley and dill instead of going into all the other herbs. So people are going to have beautiful dinners, but they might be a little bit savvier than usual.
All right, Dina, out with some timely reporting. Great to see you. That, of course, is Bloomberg's Dina Shanker. And it is Thanksgiving tomorrow. You're off on Friday. I'll be here, though, not on this show.
Gobble, gobble.
Gobble, gobble. This is Bloomberg.